All right. So we left off last week um, unfinished with the options Omega back test on the Iron Condor. We're still looking for a way to revamp the mechanical trading systems. The ones that I used to use. And I still believe that they can come back into play. But before we really start getting back into the back test, we had some people that pointed out this is really only useful for anybody who already understands the trade. And so we want to take a minute to kind of talk a little bit about Iron Condors. All right, so of course we can't do an entire walkthrough, but the common logic behind an Iron Condor is rather than just trading a put or rather than just trading a call, and we're talking like buying a call or buying a put. If I wanted to buy a call and a put and focus it right where the current market is, then all I would need to see at that point is a market expand beyond whatever I spent for the call and the put combined, right? So if I buy a 38.55 put and I spend $5 on it, then I need the market to fall below 38.50, because if I bought it with a 38.55 and I spent $5, my break even would be 38.50, because I could subtract the $5 that I spent. And I would need the market to fall at least that low for the put that I bought to start making any money. If I reverse that order and instead of buying a put, I sold a put, then I'd want the market to stay above wherever I sold it. And so the put sell becomes a little bit of a structure, a line in the sand that says, I need the market to stay above this. And as long as it stays above it, then the put that I sold, I get to keep that credit. Well, that's just one side of the market, right? So whether you buy a call or you buy a put, whether you sell a call or sell a put, either one of those becomes a vertical if you just add a wing to it. So let's look at that wing for a minute and maybe kind of understand a little bit better the way the system works. What happens when I sell a put? I'm entering into a contract. The contract that I'm entering into is that I agree to buy stock at that strike price if at expiration that strike is in the money. Or I agree to buy that stock if the person who bought the put decides to exercise their rights as a put buyer and they put that stock onto me. That's literally why it's called a put, because someone can put stock on you, force you to buy it at the strike you sold. Most brokers, not most brokers, you have to be able to cover that put. Now, the SPX doesn't have stock, but we could be talking SPY instead of the SPX. If you sell a put, you have to have enough money in your account to buy 100 shares. If you don't have that money, you can't sell the put naked. In the SPX, if I wanted to sell this, the buying power reduction, because of margin, I would only need $378,000 only. So, close to $400,000 I could sell that put. I think everybody would agree that's a little unrealistic, right? This account is barely funded. I only funded enough to be able to use Thinkorswim. I don't really trade here. I certainly don't have $400,000 here to sell a put. So if I wanted to sell a put, the only way I could do it is to offer some protection. So if I sold a put and I bought a put cheaper than the one that I sold, there would be a credit left over and I would have protection. Why is it protection? Well, if I sell a put, which obligates me to buy stock at 38.40, but I also buy a put, say 38.35, I can force someone to buy it at 38.35 if someone forces me to buy it at 38.40. So my risk is $5. It's the difference between the two strikes. So if I sell a 38.40 and then I buy a 3800, my risk would be the difference between 3800 and 38.40, 40 points. So I can define my risk this way, and the trade would be opened for a credit because the one that I am selling is worth more than the one that I am buying, and that leaves a credit left over. There's money left in the kitty, so it becomes a credit spread. Well, that's just one side of the market. What if I want more credit? I could put more lots on, I could make the trade wider, but I could also take a look at the market and maybe think about linear regression, mean reversion, this wave that we were talking about earlier today with a swing high and a swing low and a swing high and a swing low. If a market theoretically is only supposed to move within a one standard deviation, we'll just draw a circle around this and pretend that it's a standard deviation circle. If it's only supposed to move within that boundary, then instead of just selling an option spread below the market, I could sell an option spread above and below the market. And as long as it stays in between those two spreads, as time goes by, the trade loses more money. When I buy it back cheaper than I sold it, I make profit from that. So that's the theory behind an iron condor. You can skew these things and shape them to where your risk is offset. You can add lots and kind of change things around. They can get very complex, but we want to just focus on the simple dynamics of an iron condor. So on Thinkorswim, if you right click, you get the little menu. We almost always sell iron condors. Now you can buy them. There's no law that says you can't. But when you buy an iron condor, you need price to get the hell out of the box. And if you sell an iron condor, you need price to stay inside the box. If you don't quite understand why we say the words like a box, we're going to stick this into the analyzer and take a look at the shape of an iron condor, and then maybe you'll grasp that phrase or that logic a little bit. So this is the Analyze tab. We're going to go in and just hit the reset button and make sure that I haven't made any modifications that I forgot to undo. And what you're going to notice here as we zoom in, that it starts to look a little bit like a box, maybe a little bit of a rectangle, right? And this box or this rectangle has a left edge and a right edge, forming a little bit of a barrier or a channel. And what we need at a price is to stay inside that channel, those break-even points. All right, now we can choose where these break-evens go, but we really need them set at a location where we believe price won't go beyond. And we can do that using linear regression, standard deviation, mathematical statistics that tell us price should stay within these ranges X amount of time, and we can lean in on that. The problem in the current market environment is that we're in a high volatility marketplace. And volatility is a nerd word for movement. So if you're in a high implied volatility market, you're in a market that is making promises of big moves. It doesn't have to make a big move, but it's promising that it has the capacity to make big moves. If you're new to trading and don't quite understand that logic, take a look at the last 5 years. We're looking at the SPX. When times were good, life was simple, we weren't in a COVID mess. Look at the size of the day that we were dealing with. On a day-to-day basis, these candles are not very big. We're talking 20-point moves in the S&P. From the highest point of the day to the lowest point of the day, the market had a very low ATR, average true range. We're talking 25, maybe 30 points in the entire trading day. And then look at the kind of candles that we have now and the size of the ATR that we have now. It's 4 times the size of the daily move that we had pre-COVID. So high implied volatility is just a fancy word to say expectations of big moves. And the market is giving us those big moves. So you really don't want to pick a trade that says, I bet you won't move, in a market that says, I'm promising to make big moves. Those don't really go together, right? When we get rid of all the nerd talk and we strip out all the fancy language, that's the problem that we're trying to deal with right now. We're trying to put on range-bound trades that say, I bet you won't move, in a market environment that is promising big moves. My mechanical trading system before COVID worked really well. And that's because a market does even better than the promise. It promises to stay inside of a 1 standard deviation range around 70% of the time, when in reality, it was actually staying inside the range more than 80% of the time. And the range was really small. And so it was a real easy system. Now, the market is making these really big moves and it's breaking our system. So we need to define a new way to pick the legs of our trade. Where do we put our break evens? And that's what we've been using the options Omega backtester for, because it actually allows you to go in on an intraday basis and ask the question, if we had put on a trade, say at a 20 delta on each side, would the trade have survived, or would price have broken outside of it? We expect that it's going to lose maybe 1 out of 10 or 2 out of 10 times, because nothing wins all the time. And so we need to collect enough money on the winning side that when we do lose, the losses aren't big enough to completely wipe us out at the end of the year, that it doesn't just become a zero-sum game, or worse, that we get to the end of the year and we find out that we're down on the year. So that's the kind of problem that we're dealing with. There's been a lot of research over the years on iron condors and credit spreads. And the way that tastytrade's made popular is that you would want to go about 45 to 60 days out, and you would want to build that iron condor on the edges of a 1 standard deviation move within the options chain, and that you would want to collect around 1/3 the width of the spread. And if you didn't meet all of those conditions, then you wouldn't put the trade on. Say you built the trade, but there wasn't enough credit at that location, you would avoid the trade because it wouldn't meet all of the conditions. The trade we're working on is a week by week iron condor. We're literally trying to focus on what the expected move is for the next week, and then make a decision about the strikes that we're picking. So on the screen right now is the weekly expected move indicator. It's got the high side and the low side already marked out. And the problem that we're having is things are so violent right now. The price is continuing to break outside of that expected move more than it should. Now, statistically, the S&P stays inside this box even more than 80% of the time. A regular market has been proven to stay inside of its range 80%, even though it's only supposed to do it 70%. The SPX beats that and usually stays inside the box 85 to 90% of the time. But in the current market environment, that's not true. It's breaking this box week after week after week after week. So one, we honestly just may not be able to do it. Or two, we're going to just keep trying to find it until we do find it, right? There could perhaps be a setting. Now in 2020, I was running automatic systems. It wasn't a theory. I wasn't on paper. I had live money in the market, kind of that old phrase, put your money where your mouth is. And I was getting hit pretty hard because I didn't know that COVID was coming when I started the system, and I was too stubborn to call timeout. So I just kept running it and I kept losing. Or I should say that another way. I was actually winning the number of times that I was supposed to win. But once COVID hit, the size of the box became so big that I wasn't getting any real money when I did win. And yet when I lost, the losses were so big that it was more than wiping out the wins that I was getting. Right. And there's a common trade logic that says if you're selling a trade like a credit spread or an iron condor, if you're selling to open, you should probably try to close at around 50%. And that was a part of the issue in 2020 that I was coming across, because without even thinking about it, without any real common sense applied to it, I was doing what I was taught to do. I was closing them down at around 50%. But those trades were like $1 wide iron condors. And I was collecting, if I was really lucky, about 20 cents of credit in a $1 trade, which means I was risking 80 to make 20. And then at 20 cents, I was closing that down at 50% profit. So I was risking 80 cents to make about 10 cents. And that doesn't work. It doesn't work. Even if you win 95% of the time, it doesn't work. You're just not getting enough credit. So we can't just blindly follow these lines. That's not going to be good enough. We have to decide a new location to put these strike placements, these break evens, and still be able to stay within the boundaries of a market that's this violent. So that's what we were working on last week. It could be that right now we just can't do it. And that's okay. I mean, if that is the answer that we finally get to, that, hey, you can't put the iron condors on right now, it just won't work, I'm willing to accept that and move on, because there's 18 different strategies that I have for using this indicator. So I don't care if we can't do it, but I don't want to give up that easy. But we do have to recognize that when the market, the market is a very, very efficient marketplace. It does a very, very good job. That's a lot of varies. Very, 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 very good job most of the time. But when things begin to go to hell, they can go to hell repeatedly. And then that starts to cause a warning. One of those warnings we saw back before COVID hit. In the later part of 2018 and or 2019, and then into 2020, things began to unravel. We were breaking outside of that expected move a lot, consistently, repeatedly. And that was a warning. The market makers were getting it wrong. They weren't identifying the risk and the volatility that was coming into the market. And the breaches of that expected move was literally giving us a heads up that, hey, something's not right and things are about to get really bad. And they did. They got really bad. Well, if you think about the current market right now, and we start thinking back, well, how many times have we breached in the last few weeks? We breached and closed outside of the box last week and the week before that. And then we had a week where we were in the box, but then we broke and closed outside of the box the week before that. So in the last 4 weeks, 3 out of those 4, we closed outside of the box. It's supposed to stay inside the box at least 8 out of 10 times. And even if we don't handicap the market at all, it should be able to do it 7 out of 10 times. So one thing that we can do is just count back. This is a failure. This is a failure. That one is a failure. So that's 3. There was a good one. There was failure. And there was failure. This one just barely got back in. I mean, just barely. So it counts, but whoo, that would have been a rough one to hold on to, I gotta say. So 1, 2, 3, 4, 5, 6, 7 weeks in out of those 7, 5 closed outside of the box at the end of the week. This one was fine. That one was okay, but this one also failed, and this one also failed. So it could really just be this idea that right now we can't run them. The market is literally unable to do what it's supposed to do. It's not because we're putting the wrong settings into the tester. It's not because we're not being generous enough or that we don't necessarily have the right setting. The market literally is just not able to stay inside the box. That's 10 weeks right there. Seven out of 10 weeks failed. So it's only staying inside the box 40% of the time, or maybe 30% of the time, and that it's closing outside of the box 70% of the time. Now, one thing that we could try to do is the iron condor the other direction. It's called a gamma iron, but we could try to buy it rather than sell it. Like I mentioned a few minutes ago, if you buy the iron rather than selling the iron, you need price to close outside of the box rather than inside of the box, which is a unique take on things. And I am willing to consider it, but normally when I would consider an iron that I buy to open, it's after 2 or 3 weeks in a row of a market staying inside the box. Kind of like, you know, if it has an 8 out of 10 that it's going to be in the box. When you get 4, 5, 6, 7 in a row that close inside the box, you're almost due to have one that closes outside the box at that point. And so I usually entertain the idea of putting one on at that point. Not necessarily in a market like this, where we just continue to have breaches of the expected move over and over and over and over again. So I don't know. I'm willing to entertain the idea, but on the other side of it, I wouldn't have very high hopes, right? Because it's not the idea that we can look backwards and say, oh yeah, that would have worked. Great. When would I want to buy it and when would I want to sell it going forward? We're supposed to be looking for mechanical trades, things that we can apply without really digging too deep into the technicals, which is nice because that's how probabilities work, right? Without any form of technical analysis whatsoever, if I can lean into probabilities alone and have an 80% win rate and then add even the slightest amount of technical analysis to improve that win rate even more, that's a good life. So before we go over and try more back testing settings, is there any questions on the iron? Because if you don't understand the iron, then getting into the back testing really just kind of defeats the purpose. Thank you. Thank you. Thank you. All right, so nobody had any questions. Good enough. Either I put you guys to sleep or I did a good enough job of explaining that. All right, that's not the one that we were using. That one is a 1 year. I think we were using this one. Yep, that's the one we were using. So the settings on this are from January 1 to June 8. And it had 19 out of 20 wins. It had a 95% win rate. The max win was much bigger than the max loss. And everything was looking really good. And then at this point, we started running a back test last week that used pretty much all of June as a part of the back test, where this one was not using June at all. It's still set for June 8. So it pretty much was only using the first week of June. And if we were to begin back testing from this point going forward, when we start making the changes, that's where all of our train wreck started to come in, right? We were getting significant losses. Max losses were bigger than max wins. Everything was just wrecked. Well, we were just looking at the chart that showed why we were wrecked. We're getting outsized moves way beyond what a market is supposed to move on a day-to-day basis. It's not the back tester's fault. It's not our fault. We're not putting in bad information or bad tests. It just can't manage the current market environment, right? The market is just too violent, too extreme. So I really don't want to change these settings. I want to leave them alone. And if I was going to run something like this, perhaps I would run it when I did not expect to continue to get these breaches. So maybe this is a time to call timeout and talk about what kind of trading we should do when we're getting these kind of breaches. And how would we know in advance if these breaches are coming? You know, like, can we see that coming so that we would know to swap strategies? And or how do I know it's going to continue? Because we put them on from Friday to Friday. And well, how do I know that this week is going to do the same thing that happened last week? Right? Like, if we're going to make that distinction, we need to be able to make that distinction somewhere, somehow. And hopefully it won't be from technical analysis, because the whole promise of a mechanical system is that even a new trader with little to no ability at running technical analysis can still run a mechanical trade. That's the unicorn, right? The promise. So one thing that I was thinking about is an age-old question that Tasty Trades had solved a few years back. And anybody who's been trading for a while probably has run across this. What's better? To put on more lots or to make your trade wider? That's a fair question, right? Say I want more money. Should I put on, instead of 1 iron condor, should I put on 10 iron condors and then get 10 times the credit? Or should I perhaps put on only 2 or 3 iron condors, but make the iron condors spread much wider? And it could be the same thing for a credit spread, you know, or a butterfly or anything like that. What's the better solution? To put on more lots or to put on a wider trade? And Tasty Trades did a lot of research on this, and their answer is that it's better to make the trade wider for a number of reasons, but one of them includes the idea of thinking about where your break even goes. You'll actually give yourself a better position if you make the trade wider. Two is because if the trade is wider, it exposes the trade to more Greeks, right? If you put on a 5 lot, you didn't buy or sell 5 times more Greeks. You just increased your risk, but you didn't gain any Greeks. You didn't multiply your Greeks by 5 or 10 or whatever. And yet, if you make your trade wider and you open it because it's wider with more Greeks, then you've exposed the trade to more Greeks. Kind of a Captain Obvious solution, but it escapes a lot of us, right? So there is that argument as well. So when it comes to these mechanicals and dealing with the current situation that we're dealing with, rather than making it $5 wide, and we already know we're going to do it on the SPX, I mean, we can run back tests on SPY if we wanted to, but I'm deliberately targeting the SPX here. If we know we're going to do it on the SPX, why make it the smallest trade possible when we could widen this thing out a little bit? Now, my solution in 2020, when I was getting murdered in my mechanical, what I ended up doing was, one, going all in. So the trade was either 100% win or 100% loss, because I was already getting 100% loss. That wasn't something, that I was really able to make a decision on. But the profit side was something I was able to make a decision on. And then the other thing that I started to do was I added double diagonals instead of just plain iron condors. And I did a video series on that. It's in the Next Level library. It's called the Marcus trade. I named it after Mr. Marcus, my dog. So eventually, we may have to do something where we add some structure, but we're just going to go ahead. We'll start a new back test. January 1 to the current date. So we'll just tell it year to date. Iron Condor. 7 days to expiration, starting with a 25 delta. And we're going to go 3 strikes wide, which is $15. We're not going to mess with the time frame yet. Still getting in kind of early on Friday. We're using exact days to expiration. So if there's not a trade on Friday because of a holiday, then it just won't put the trade on. I don't like putting trades on in a short week. It never turns out good. Mechanicals don't work the way that they're supposed to. So if it's not a Friday, this won't run. We're using 10% of 20,000. And because I just made this much bigger, we may have to adjust these numbers, right? Because there may not be enough buying power in an account this size to manage an iron condor this big. I don't know. We're learning together. We don't need to worry about how many trades are open because they're going to be closed each week and we're opening new ones each week. I'm not going to mess with any of the target profits yet. We're just going to see how everything unfolds. I still want 2 hits for the profit. We're not going to black out any dates yet. And then we're not going to mess around with any minimum requirements yet. So let's just pop this thing out there and see what happens. All right. The max loser is brutal, punishing. And we can see that for the last, there was a significant drawdown here. it wasn't putting on any trades right there. Big loss. We can pretty much see those three losers, right? One there, and one here. Those three losers were enough to cripple this strategy. It kind of goes back to that old argument that it's not about the win rate. You can have a strategy that only wins 10% of the time as long as the money is right. So it's not about the win rate, except in this strategy, unfortunately, the way that we've been working on it so far, the win rate is absolutely critical. And that's because I don't have a stop on this. Now, if you're running your back test and you want to try to use a stop, by all means, that's what discovery is all about. But from my own experience, running a week-to-week iron condor, one thing that I found absolutely unarguable from where I sit is a way to handicap the trade by using a stop. Anything that you sell to open, whether you're still in a winning trade or not, the P&L in a short duration trade, no less, the P&L is very violent. They call it your P&L gamma. It's very violent. It's bouncing and jumping all over the place, and it can very easily hit your stop, even if the trade was still a winner. And today is a perfect example. The scope and the depth and the breadth of the move to the downside today very likely would have triggered your stop. And yet, we're still inside the box. So if you had hit your stop today and it kicked you out of that winner, that would suck because your trade is still a winning trade at this point. You're still in the box. So we can't use a stop. We just can't. Now, the thing about the back test that I'm willing to concede is that we humans can step in and we can kill the trade on our own and perhaps not take a max loss, right? Because remember, the back test is not law. It's giving you a picture, and it's our job to kind of zoom into that picture a little bit and make a case for the idea of, hey, is this a good strategy? So it did have three losers. And we can look at the back test and we can actually get the dates. When did those three losses actually happen? One was at the end of January, right? So we can kind of just hold the mouse there, or we can just go in and look at the trade log. Where's the loser? Right here. Friday, February 4th at 3 o'clock in the afternoon, that trade was closed down as a loser. And it was a significant loser. It was big. Let's go out to the chart and take a look at Feb 4. February 4, that date. It looks like it's inside the box. I don't see why it's considered a loser. What am I missing here? That should have very easily been a winner. Did I miss something? Or maybe it was opened on Feb 4. Well, let's read it all the way through. Maybe I'm missing something. It was opened January 28th. It was closed on Feb 4. Let me just take a picture of it so we can carry it over and look at it on the other screen. All right, we do a little multitasking. It says that we had 44.20 and 44.35 for our break even. That's not even close to these lines. 4,300 on Friday, January 28th. It says that's where the opening price was at. Let's go back out and take a look again. 4,300. Well, we didn't open at 4,300 on that Friday. Nowhere close. Friday, January 28th, 9:43 or 9:45 in the morning. All right, so maybe we were at 4,300 at 9:45. Maybe that's the argument. So let's go back and take a look. Friday the 28th, 9:45 in the morning, we were at 4,300. So there you go, right? The data right there. So when it said open, I automatically thought it was talking about the market opened, but it's talking about where was price when this trade was opened. Big difference. All right, so now we know what that open means. And since the market was at 4,300, it was looking at the deltas from that particular location. Still doesn't seem like a very wide iron. It's 15 points. I wonder if we're not getting, well, we don't want to mess with that yet. We're going to probably have to adjust the premium. But all right, let's go back out and look at year to date. January. Make sure it wasn't a Fed week. 125 was the Fed start. That's Tuesday. The 26th was the Wednesday, Thursday, and then Friday. Friday the 28th, that was a Fed week. And then we had that move out. So as one of those blackout periods, if we were to add no trade on the Fed week, then we would be eliminating this trade. Not early. It's not like we're looking back and saying, well, I'll just not trade that day, because that's not how we get to do things. But we have earlier already discussed the idea that we probably want to avoid economic events and holidays. See if I can, hold on guys, I got to figure out how to add dates to this. So we're going to go over to Option Omega's Discord for a moment. We're going to look at their releases because they just recently added this, and I think this would be the fastest way to find it. Aha, right there. So this is how you add blackout days, right? You put the year first, and then the month, and then the day. And if you want more than one, add a comma, right? So we're talking about 2022, January 28th, and that's the one that we're going to eliminate. at least the first one. Let's see if it gives me an error. We'll know if I did it wrong. All right, so that date no longer has a trade there. And I really don't feel like we're cheating because I don't like to put on trades on FOMC weeks, and I don't like to put them on during short holidays. So let's look at the next one. March 18. That's a Fed week. I know that's a Fed week because my birthday is in March, and it was not very far away from the March Fed meeting. So Tuesday, Wednesday, Thursday, Friday, March 18. Let's just check to make sure I got my dates right. March 18, that Friday, right? We would have avoided the week before. And, you know, it's worth arguing that you shouldn't do the week before, which puts you into the Fed week, but you also shouldn't do one on the Fed week for the next week. That's something to think about. We're going to add that discussion later, but we're going to block out the 11th. I got to tell you guys, I love this. I love this machine. This thing is just awesome. But I'm a nerd, and that's just what I like. I like it. It tickles. All right, so we've eliminated another trade. We actually eliminated a winner because we eliminated the trade before the meeting. That loser is still there, right? Because after that Fed announcement, that's when Apple made like that massive 2-week run. And it was just a significant blowout move to the upside. Not the 12. What am I doing there? That should have been the 18. All right. Now we got to go back to January. If we cut out the week on one, then we need to cut out the week on the other, right? So we need to cut out January 21 as much as we need to cut out January 28, right? If we're going to stick to the set of rules, what would the rules say? The rules would say on Friday, we would look ahead and say, oh, hey, FOMC is next week. I'm not putting a trade on. And then during the FOMC week on Friday, we would say, we just had FOMC. I'm not putting a trade on this Friday. So that's January 21 that we need to add to the blackout dates. The good thing is we won't have to go in and continue to do this because we're going to write those dates down or take a picture. And that way they will just be a part of all of our conditions going forward, right? So doing this kind of work kind of feels a little like we're running in circles, but we can carry that logic forward into other tests. And that's definitely something that I'm going to look to carry forward, right? Now, the thing about filters that I've always said is I don't like them because they do a really good job of eliminating wins as much as eliminating losses. If you notice, the number of trades that we have now have gone down to 18 trades. All right. Let's look at that last loss now. This one was Friday, June 10, closed on the 17th as a loser. So we come back in, run to June. June 17, dun, 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 dun. Guess what? It's a Fed week. Don't you love it how it all comes together? So we want to get rid of the 17th because that was the actual week. But we got to get rid of the week before that too, because that's what we've already been doing. Now we have cut out all of our losses. Did we cheat? I don't feel like I cheated. It makes sense to avoid econ, right? I really feel like that is common sense. We don't want econs. We don't want short holiday weeks. And if we already know that we can cut more of these down, it would probably cut the trade number down to say 13, maybe 12, because if we cut out Martin Luther King Day and Juneteenth, Memorial Day, right? We start cutting out holidays and the winners are going to go down more, which makes sense. I mean, that's fair. So it would still cut into the amount of wins, right? But what we have built here doesn't have any losses. No cheating. Let's go count out those holiday weeks and add them to this. Because remember, once we have these dates written out, we will never have to go do this work again. They'll just be something that we can copy and paste into every new strategy that we do. So it's worth doing a little bit of the legwork just to go ahead and get it done. And this is kind of the answer to everybody who asks why I'm still in the office at 11:30 at night if I work for myself. I'm still in the office because I'm doing this kind of stuff. January 17 was a short week. So if we weren't going to put a trade on in that short week, then we would want to eliminate the January 14 Iron Condor. Now it would be good if there was a little place for notes, right? Like if you've used Tasty Trades, the desktop version, it doesn't have a place for a journal. But if you go over to Tasty Trades on the web, it does have a place for a journal. That would be a really good thing to add to the feedback and suggestions. One thing that I like about these guys, they are traders. They built this to help them trade. and they love feedback for anything that can make it better. So I never hesitate when I have any kind of, ooh, that's a good idea, to run over there and toss it into the kitty. All right, that eliminated another trade, but it's good logic. I've never liked putting on a mechanical trade knowing that the next week was going to be a short week. Okay, so here's another short week. It's February, that's Martin Luther King week, right? Martin Luther King Day. No, wait, that's February. Martin Luther King Day is in January. And it's not Valentine's Day. So what is that? I mean, I can see that it's a short week, but I don't know what the holiday is. Any takers? What, I put you guys asleep? Wake up. Either way, it's the February 18 is what we need to eliminate. President's Day. You nailed it. You beat my wife to it by like 30 seconds because she got up and was looking at the calendar. Thank you very much. President's Day. All right, so we got to eliminate that week. And that would be February 18 that we need to cut out. Well, it's just cutting us down, isn't it? It's getting lower and lower and lower. It is fun. It's almost addictive, to try to the first try, of course, is to get it to where there's no losses. And then the second try is, ooh, how can I make more money? From my little nerd world, oh, it's totally addictive. I like to make it as absolutely difficult as I can and still see nothing but wins. I love it because I like to size up when I have conviction, right? And when I know that a trade has like a 99% chance of winning, I go in with conviction. All right, so we've gotten rid of President's Day. There was the Fed week. And here's another short week. That's the first week of May. Pretty sure this one is military related. 4/8 is the one that we're cutting out. So no, wait, that's not May, that's April. Good Friday? Yeah, Easter, right? Yeah. Yeah. That could totally be Easter. Good Friday, Easter week, Easter weekend, something like that. For some reason, I thought that was May, not April. So April 8, we got to cut that one out. Man, we're cutting out all the trades. That is the problem with filters, though. They do their job. All right, so there's the May. Yep. Memorial Day. So we got to cut out 5/27. And then it's funny, Corey, that you said that. We've been watching Madam Secretary, and some dictator, like somewhere in the world, in the show at least, I don't know about real life, had named one day as a holiday, and it was the president's mom's birthday. I don't know what country it was. All right, so now we got to mark Juneteenth, which is a new holiday that they just enacted last year. It was actually ratified last year, and this is the first year that it had ever been celebrated. And that was 6/24 if we were going to cut out the short week, right? 1, 2, 3, no wait, the week before that. 6/17 to cut out the short week. I've already got 6/17 on there because it was also the Fed week. That can't be right. Did they overlap? Let's go back and look. Yep. We cut 6/17 out because it was a Fed week. We also should have cut out 6/10 because that was the week before the Fed week. We're really cutting out all the good stuff. 6/10. I got 6/10. All right, so we got them all. Right, that's all the holidays to date. At some point, we're going to want to go in and add all the other ones, but we've got everything cut out that should be cut out. And now we're looking at 13 trades with 13 wins, average time in trade 4.5 days. The entire length of the trade is 7 days, which means the average close is somewhere on a Tuesday or a Wednesday, right? We got Tuesdays, Wednesdays, so we're closing early. We're hitting that target profit reasonably decent. But now that we've eliminated all those losses, we want to really start putting some screws to this thing. One, make it as difficult as we can. Add commissions, add bid-ask spread, slippage, the works, right? We want to make it as punishing as possible. And then we also want to add our percentages, right? As much as we can. Now, obviously, pushing these too far is going to start to cause losses, and that's where we're going to start to recognize that we've gone too far. But first, let's add in some common sense stuff. Yeah, I know common sense isn't so common anymore. Slippage. The SPX, you know, about 20 cents slippage. I really don't feel like we're out of line, right? I mean, that SPX, the bid-ask spread, it gets pretty ugly out there. Kind of coyote ugly, right? So that didn't hurt. I want to bump it up. I'm going to keep bumping it up until I see that we bumped it too far. So let's add another 5 cents. Now, we all know that I'm willing to work the order. Hopefully you're willing to work the order, and that you don't have to actually take that kind of punishment in the bid-ask slippage, right? But we want to make this thing as realistic as possible, and we want to feel the worst pain that this thing can give us. Rainbows and sunshine isn't the time for that, right? We want to make it like just brutal. So within reason, I don't think more than 50 cents, right? If we keep it below 50 cents, we're staying in reason. So let's go ahead and bump it up to 50. That's 50 to get in and 50 to get out. That's pretty rough. And it still did not destroy anything, right? So you talk about being fair and not painting too pretty of a rainbow. You're talking about slipping 50 in and 50 out. That's $100 of slippage. Now, for anybody who says, come on, man, you're kind of going overboard there. Am I? Because that's 40 cents of slippage right there. right? And I'm not even cherry picking. I just stopped right there and I can show you a 40-cent slippage. So 50 cents is not out of line. Let's make it rough, right? Because if we were putting on a spread, just one side, one spread, we would be dealing with slippage. And how bad is it when you start to get out of the money where our iron condors are at, right? Remember, we're pretty far out of the money, dealing with like a 25 delta and probably something closer to like an 18 delta. So I don't think we're out of line pushing that. Yeah, look at that. Well, we've got some significant slippage even way out here, 20, 30, 50 cents. So let's keep that in play. And then what else can we do to cause some pain? We could try to eliminate the horrible slippage by ignoring trades with a really wide bid-ask spread. Let's just see what happens if we do that. No change. All right, so we're going to put that in. That way, going forward, if we start to recognize something's going wrong, maybe it'll because the bid-ask is starting to get a little nasty. Now, I'm not quite for sure because it looks like they left. But if anybody from Options Omega is still here, if you can add some insight onto anything else that we could do to make this more punishing, to make it more realistic or more accurate, throw it in the ring, right? Let us know what else can I do to turn the knobs and make this more painful. So now that we've adjusted the pain as much as I understand how we could, oh, well, we can add commissions, right? Of course. Yeah. We're talking about, say, $1.50 to get in and $1.50 to get out. Now, somebody asked me the other day, why is the SPX a higher commission than the SPY? Well, the SPX is actually a product brought to us by somebody, and they have the right, since they're the only ones providing it, to put a fee on it, and they did. Thank you, appreciate it. Right, so that's why there's an additional fee when you trade the indexes. It's just the way it is. Monopoly kind of comes to mind. No, I didn't say that. That wasn't me. All right, so we've got commissions built in. That changed our time in trade 100%. Whoa, we still got the wins, but look, we gained a day by making these changes. The average time in trade was less than 5 days, and now it's not. Now we're going to be in these things until Tuesday, maybe Wednesday. No more Monday exits. That kind of sucks. That's all right, right? I don't want surprises later. So I want to make it as difficult as possible. Well, we already know that this is probably going to cause a loss, but let's rack it up to 50% on that target profit. Yep, that brought some losses in. So we can't just run it at 100% profit. And those two losses were significant. I mean, they took a massive cut out of our profit. So we can't go to 50%. Let's knock it down to 40. See if we can get some guidelines here. All right, we got one loser. Where's that one loser at? From May 20 to May 27. Let's go out to the chart and just kind of see what area we're dealing with, right? Should this have been an obvious, like, hey, Captain Obvious, shouldn't be putting a trade on right there. I'm not seeing anything. There's nothing here that would have told me, dude, you should totally not have put that trade on. What were you thinking? So we wouldn't have seen that one coming. I think this is a case of pushing the machine too far. There's a reason we take profits early. And I really believe that this is just the purest example of that. So 40, too much. Let's back it off a little more. Remember, we were at 25%. So if we can do better than 29%, if we can do better than that, then we're improving the system. So let's try at 35%. Still don't have it. All right. 32%. There we got it. Let's try 33 then. We'll just squeak every little bit out of this thing that we can get out of it. Nope. That's the line, 32%. Now, in the real world, right? Not playing around with the back tester. In the real world, if we know we're skirting the line between a 1 win and 1 loser, and we're talking 2% profit, are any of you really willing to threaten a loss just to get 1 more percent? Because I'm not. I am much more willing to back this thing down to 29, heck, even 25, as long as it's got some real capital on the other side of it, right? So we are right on the very edges. If we change even 1% more, we're going to get a loss. And that says in 13 trades with 13 winners, we would have made around $7,775 after paying commissions and the slippage and all of that. Okay, I mean, remember, this is a picture, right? It's not exact. If you scroll through the trades, you'll see that as the account grew, so did the number of trades that was put on. They're already $15 wide iron condors. And it's been 2 and then 3. And if we were to continue to run this thing, it would get to like 4 and 5 because it's using 10% of the entire portfolio. So as the portfolio grows, so does the number of trades that are being used. At some point, you just got to call timeout and say, look, this is getting ridiculous, right? Can you imagine running 15 or 20 of these iron condors at a time? Not me. I would feel that there's just too many eggs in one basket, right? So I'd get a little uncomfortable with that. So we would probably want to cap that out at some point and say, you know, probably maybe no more than 5. I don't, that's my own personal take. The good thing is each of you can make that distinction for yourself, right? So what else could we do to this to make it better? I would say that we put a minimum credit on it, right? There was a few of these that was getting $7 of credit. That's pretty good in a $15 wide iron condor, which is out of the money as far as we are. I think that's a really good credit. And I don't see any 5s in there. If I did, I would say let's put something like it needs to be more than $5 credit. Because remember, a year from now, when everything is completely different, we may not even be able to get $6 credit that far out of the money. But we're looking, and that's the beauty of this platform. We're looking at, hey, what works right now, right? When things change and we're back in a bull market and, you know, 5 years from now, everything is sunshine and rainbows again, we can go back to the old way, the way that we were doing things, and we won't need to worry about these extreme moves. And we can make my old way even better because we'll have this. I like this iron just the way it is. I don't know what more I would want to do to it from a back test perspective, other than maybe asking a question, can I change the strikes? Can I get closer? It's what I always want to do, right? Personally, I always want to get a little bit closer. So let's just push it a little bit and kind of ask that question. Could I have used a 30 delta rather than a 25 delta? Because if I can get away with that, I definitely want to. Okay, that cost us a loser. It's that same spot. right? Remember when we adjusted the target profit? It's that May trade. We're going to back the profit off a little bit, take it back down to 29%. I'm not giving up on that delta yet. It still didn't change anything. But you know, we pulled more money out of the market by using a better delta, even though we had one loser. Before we didn't have any losers, but we know eventually we will, right? I mean, you're not going to ever get a trade that always wins. That's unrealistic. So this is telling us we can get a little bit closer, and because we're closer, we can get a lot more money out of the market. You get a better credit, and you also get less risk. I mean, you got to love the less risk part. So I would almost argue that this is a better fix than the other. This is a better trade. Now I know some of you are thinking, no way, man, this trade has a loss in it. I don't want it. Use the other one then. I mean, I can reset it and you can use that one, but I would say this is better. You make more money, and even on the one that lost. So here's the man-made input on this. Let's go discuss that for a second. Should you ever step in and just like shut the thing down? You think 2 weeks ago we may have wanted to do that? We broke out of the lower end of the expected move on a Monday. Wednesday, we tried to rally back into the box and it failed. And on Thursday morning, we opened to beat down and was still heading to the downside. You think at that point, you probably would have just said, screw it, and closed it. Or at the very least, maybe rolled those calls down to where we opened on Monday. Because if you roll those calls down to around the 38.40 area, you could have got a lot more credit out of those, and you could have reduced your loss on the put side, which is why, again, this back test is really awesome, but it doesn't reflect what I do as a trader, because as a trader, I don't just sit there and take it. I mean, if I know that I can roll it or adjust or do something, I do that. So this one snapshot, this one loser, I'm willing to accept that in this back test because we see some pretty good numbers here. That's almost an $8,000 gain in 13 trades. 13 weeks with a $20,000 account. So that's not bad. I mean, and think about the violent market that we're in right now. You telling me that in this chaos, in this madness that we're dealing with right now, that we can still get 12 out of 13 wins? Hell yeah. I like it. So I want to save this. We're going to go up and we're going to put a name to this thing. I'm going to call it Extreme Price Iron Condor. Weekly Iron Condor. All right. Now, unfortunately, I can't share them, right? It's not like a link to Thinkorswim that I can just copy paste. So the way that I have to copy or share it with you is to go through the settings, maybe even just stopping to take pictures along the way, right? So I think the easiest thing to share, first off, would just be this screen right here. And then we can break it down and I can take screenshots individually. We didn't look at it this day, but I can tell you that I have looked at it. The way I used to do it was in the afternoons. And when I started running the back test, it sucked. I mean, it was horrible. And I was like, what is wrong with my trade? And I started trying all these different things to figure out what was going on. And one of the things that I adjusted was the time of the trade. Instead of getting in after 3 in the afternoon, I found that getting in the morning actually produced better results. And when you think about the why behind it, this kind of makes sense. Think about it from time in trade. An iron condor doesn't need price to move for it to be profitable, right? It needs price to not move, but it really needs time to go by. If you get in on Friday morning, well, you get an extra free 12 hours. But if you get in Friday afternoon, you don't have those 12 hours of decay, right? You're literally cutting out 12 hours that you could have had that decay kind of pushing on your trade for you. So the reason we were looking at afternoons is because we thought that those lines would be more accurate. But since we're not using the lines anymore anyways, getting in the later part of the day has no bearing anymore. So the picture that I just posted is like a broad outline, but we want to kind of get a little more detail. So I'm going to come in and I'm going to take individual pictures of some of these settings. And that way, you know, if you are on your own back tester and you want to set the settings the way that we have them, you'll know what settings to set, right? It's the best that I can do because there's no link that I can share with you. I don't really see how I could request that either. You know, like the first thing I ever think of whenever I run across a problem is, ooh, I wonder if I can ask them if they can add that to the platform. But how would you add a share link to something like this? Or, you know what I mean? Like, would it even be something that is theoretically something that could be done? And I can't think of it. I mean, I'm not a coder, but I generally have a pretty good feel for what's doable. And I find that one hard to wrap my head around. So I'm not going to go over and request if they can add a share feature. Now, the reason I posted that is so that you can copy and paste it. All right. So I would say that iron is just about where we would want it. Hold on just a second. Got to go looking through something. Bum, bum, bum. Let's see. Count time out for a second. All right. So we went over a lot of stuff. I really feel like we got the iron condor dialed in. What I really want to kind of look at right now is leaning into it and asking, is there any reason that we wouldn't put this trade on? Right? Like, do any of you feel that this is a bad trade, or that we cherry picked the results and that we wouldn't want to use it going forward? I don't feel that way. And the reason I ask is, a lot of times it's easy to get down so deep into the weeds that you lose sight of the bigger picture. It happens to me just as much as it happens to anybody else. And if I have a blind spot, I would really love it if somebody pointed it out, because I don't want to lose money any more than anybody else. Right. And I mean, that's just the end of the story right there. I don't know everything, and I can certainly make mistakes just as much as anybody else can. So if anybody sees a glaringly obvious error that we need to address, by all means, I mean, let's dig down into that and find out how to fix it, or at least bring it to the surface. If not, these are the settings that I'm interested in using. And at this point, the next thing that I would want to do is change the look back. We only tested the current violence, right? But we didn't ask the question, do I need to change it later on when we're not in such a violent market? Can I use the same system as it is, or am I going to have to adjust this later on? And when will I know when to do that adjustment? So kind of the next step in the benchmark is going to be, let's change the date, right? Say, like, looking back over the last 2 years. Now, obviously, we're going to have to go in and we're going to have to cut out a lot of those days, holidays, FOMCs, all of that stuff. We got annihilated, right? Knocked the win rate down to 75%. Average time in the trade was almost the entire week, and a lot of losers in here. But if we were to go in and start cutting out those FOMC weeks and the short weeks, how many of these trades would we eliminate, and how many of those losers would we eliminate too? So for the time of the capital, how much time you're going to spend in trade would really answer that question. Let's put it back where it was. And the average time in trade was around 5 days, 5.5 days. It's a 7-day trade. It looks like we're getting out on Wednesdays and Thursdays. I know all of us like to look at the summary where it just shows, this, but I like to look at the trade log, because it's what I'm already used to looking at. When I look at my own P&L, my own trades, this is usually what I'm looking at, something like this. I got in here, these are the legs that I used. I don't look at some pretty summary of my trades. I look at a trade log. So this is comfortable and normal for me. So I'm looking at, like, what's the premium we're collecting, and, what's the closing price in the market? What day did we close on? And that really kind of highlights, we're getting in on the 7th, we're getting out on the 13th. It was a Thursday. All of our entries are on Fridays. So I'm really just looking at, where's our exit? Mostly on Thursdays, it looks like. Thursday afternoon seems to be pretty common. And either way, it's a 7-day trade, and we're getting out before day 6 on average. Yep. So I'm feeling pretty good about this. I don't want to make any changes, and I'm ready to start running it. So this Friday, we're going to look to put this trade on. I'm not going to use probably as many lots as they used here, right? I'm not going to do 3 lots and 5 lots, and I'm going to do a 1 lot for right now. But I'm already going to be streaming. So on Friday during the live stream, when I'm already in there doing what I do, we'll just take a little bit of time at about 15 after to build the trade, and we'll throw it on there, right? Now remember, if you wanted to, you can back away a little bit, right? You don't have to do it exactly as it's built here. If you have your option Omega, you could, let's talk about what you could adjust, because I think it's late enough at this point. I wouldn't want to start working on any other project today, like doing a vertical or working on a whole new thing. So let's just go ahead and talk about some of the choices you have at your disposal that you may want to look at for your own back testing. If the size of this trade makes you uncomfortable, then making it to where it's not 15 points wide would be one of the first things that I would recommend that you change. The next thing would be that 30 delta. If you were to back away, say go back to 25 delta, maybe even a 20 delta, I really don't think that would start causing this thing to lose. All right, now, I'm not going to do it because I'm looking to get off of here within the next 13 minutes. But we're talking about moving the delta farther away from the money, right? So like a 25 or a 20, maybe even a 15 delta, you're going to get a lot less money, but you are also very likely going to have even less challenge against you, right? Like it should not come against you as much. Which is very likely to mean that you also would perhaps be more comfortable with more lots at that point. The other thing that you could focus on is, like Johnny mentioned, what time of day you're getting in. I like the logic of using the early morning, but we've seen markets lately that have made significant moves on Friday. And if you get in early on Friday and then the market makes a 3% move in one direction, you're handicapped severely. So there could be an argument of maybe bringing back that later time frame, or even just a midday, right? That way you're not getting in at the end of the day, but you're also not getting in first thing in the morning. I don't want to run those tests myself necessarily. I'm kind of burned out, want to take a break. But if I was looking to make any adjustments to this, just to see if it could perhaps get any better than what we've got at this point, those would be the things that I would focus on. Now, what I'm going to end up doing is all those pictures that I shared with you guys in the chat, it's going to get put into my journal here, because I've got my own little Option Omega Discord where I've got my notes and pictures and stats, and I'm going to keep those. And see if this thing pulls up just the way it's supposed to. Yep, everything looks right. This is year-to-date extreme price weekly iron condor. That way it gets named correctly. And that way, if we do have to do anything, we've got all of the information already saved, and we don't have to go scrolling back through the chat looking for this stuff. Now, remember that nothing is guaranteed. Nobody is saying, let's use the disclaimer that's really popular. Past results are not indicative of future results. Trading involves risk. Assume your own risk per trade, blah, 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 right? Did I nail it? Pretty close. Maybe add the little disclaimer, options are risky. You can lose your entire allocation, something like that. I think that pretty much covers it. So obviously, don't take your entire account and throw it onto a trade like this. There's never been a reason to go all in on anything ever, right? So we don't want to do that. And I know I've had feedback already about the stop loss. My own personal judgment is that I don't like a stop loss on things that I sell. If you do, by all means, throw your stop loss on this thing and back test it and let it hopefully convince you that it's a bad idea. I know your intentions are good. You're trying to protect yourself from a big drawdown, but what you're actually going to end up doing is killing good trades that would have won if you hadn't had a stop loss on there. So as much as it could protect you from a serious drawdown, it will actually expose you to more losses along the way. So you'll get the bad drawdown cut, but you'll also cut out a lot of your profit, more profit than you would protect yourself from loss. There's not enough discrepancy between the two to make it worth my time. I'd rather take the full drawdown and consider that I am more than capable on my own of perhaps rolling the trade or adjusting it or in some way modifying my position rather than taking that full loss, and rather than having a machine boot me out of a trade because the P&L changed in a way that the machine didn't like. If you are planning on doing these trades and you're using Thinkorswim, one thing that I could recommend to you is to set an alert on the delta. Delta is something that we use for an indication of our risk. It's like a probability meter. So when you're putting a trade on with a 30 delta, you're basically putting a trade on that says you have a 30% chance of losing. Well, what if that was to have doubled and your delta is now at a 45? Wouldn't you want to know that your risk just doubled? So what you could do is you could set an alert on the delta column and say, hey, let me know if my delta gets to 45. So you just go to the delta column and you right click and come down to create an alert. And what you'll notice is that it says delta. So this thing will let you know if the delta gets above 45. And if you started at 30, if it increases by 15%, then your risk just increased by 50%. Right? If it increased by 15 numbers, your risk increased by 50%. That's an important number to know, right? So that way it doesn't kick you out of the trade, but it at least gets your attention and says, hey, man, hey, your risk just got serious, right? Because now your chance of losing just increased significantly. And that way you can make an informed decision about what you want to do with the trade rather than just having it arbitrarily kick you out. That's what I would do. Yeah, so I'm going to put this trade on Friday. I will be doing it in the live stream because I'm already going to be streaming anyways. And, if y'all want to participate, cool. If you want to do it in paper, even better, right? I don't want you to do something that you're uncomfortable with. And I don't want to encourage you guys to just blindly follow something that that I'm doing. I am going to do it live though. I'm not going to do it in a paper trade. I have commitment issues. So if I try it in paper, I'm very likely going to forget about it, right? But if I do it in live money, skin in the game will keep me entered into the trade. I'll actually pay attention to the darn thing. So if you guys don't have any questions, we'll go ahead and shut it down and maybe look for some moves in this power hour. I'm not really hyper about the idea myself, but I mean, there could maybe be something in here. I'm feeling pretty good about that morning briefing today. I think I nailed it when it comes to all of those targets that we had talked about. Look at how price responded to those lines. Those are the same lines. I didn't go in and redraw them. Pretty good job. And the downside targets was that we would get to, if we were to break down, that we would get to the halfway point. Yes, we did. And price responded to that just beautifully. And that we're not yet to a full ADR, right? So we got a little violent without getting super violent. And that there is still more room to go. Just remember, guys, that the dollar and the bonds are going to close in about 5 minutes. And if they have been putting weight on our market, well, they will be gone now. And that means the market could buoy to the upside. I'm not seeing anything that would say that we're going to buoy to the upside, though. So don't try to go long just because, right? That's a bad idea. If we were going to go long this afternoon, we would start to see turns or changes in the cumulative tick and in the tick, advancing versus declining issues, and in the cumulative volume. And I'm not seeing any of that, right? And then plus we would have things like the weighted AD trying to turn around, and we're not even getting that, right? So nothing is calling a reversal here. Now, having said that, I'll put a little asterisk on there. If you've had a market doing one thing really strong all day, whether it's an up move or a down move, the market internals that we're looking at, they will be too slow to respond. By the time they actually turned around and showed you something good, it would be after price actually ran all the way back up and got very close to VWAP or very close to the market open. And we're a long ways from either one of those two devices. So these internals will just be way too slow to be any kind of confirmation if we rally up off of the bottom today. The only thing you're really going to have that can help confirm that for you is the tick, because it's a very responsive tool. It'll go into the green and stay there. It will quit this back and forth stuff. The AD could very likely turn around, the weighted AD. So this thing might start heading towards zero really quick. And other than that, it's going to be things like Bitcoin, Tesla, the XLF or KRE, something like that, right? Some other market, something else that can move as fast as our market. So if it is a reversal today in the last hour, that's where you're going to want to look, right? And other than that, guys, I'm going to go ahead and get off of here. And I'll see you all Friday.